Welcome back. First quarter earnings season in full swing. This is the peak week. We're getting a slew of big ticket earnings reports that will likely drive market action today. Names like Procter & Gamble, DuPont, and T-Mobile all reporting before the bell. And then after the market closed tonight, we will hear from technology heavyweights Apple, Twitter, and eBay. We want to bring in Federated Investor Senior Vice President and Senior Portfolio Manager Gallo. RJ, good to see you. Thanks so much for joining us.
Good morning. Thank you for having me.
So what do you do in the face of all of this data? You've got all those first quarter earnings. This is the peak week. A third of S&P 500 companies report earnings this week, so we'll get a real window into the corporate sector. At 8:30 a.m. this morning, we get durable goods out. We got PMIs, that's the Purchasing Managers Index, and the Consumer Confidence Report. What's your take on the broader backdrop in terms of the economy and how it drives markets?
Well, you're right. It's a very heavy week. As far as the economy is concerned, it's pretty clear that this first quarter that's behind us was a deceleration, a slowdown. Now, that said, we're still expecting GDP to be positive. Sounds like a low standard, but still positive. And we're looking for a recovery as we move forward into the rest of 2016. This week, of course, we're going to get a lot of data. The earnings season is particularly important because risk assets have been on a roller coaster during this calendar year. Obviously, they're up sharply from the February lows. We don't want earnings to disappoint too much because we wouldn't like to see additional market volatility like we had a few weeks or months back. As far as GDP is concerned, that's a key looking backwards, and we want to see if it suggests whether or not we have some strength going forward. In particular, the consumer and what's happening on the inventories front might give some light as to where we're headed. We know that this is a backward-looking indicator. We've basically seen what happened in the first quarter. But nonetheless, the GDP this week is expected to be up 0.6%.
Yeah, it's
wow.
Anemic. It's anemic.
You're talking about anemic situation here.
And you have a recalibration every time they say, oh, we're going to be at 2%, then it gets refocused down to 0.5, 0.6, 0.7. And I'm hopeful that at some point we're going to start talking, the candidates are going to start talking about the economy and how we get out of this sluggish economy. Because don't forget, Hillary Clinton will actually be continuing on, Dagan, as you said, with Barack Obama's policies. And you can see now in a perfectly timed storm that all these earnings are coming out, growth is anemic, and they're talking about everything except the economy.
She actually wants to make the tax code more complicated than it already is.
And raise taxes.
The complete
opposite
opposite from what you hear on the Republican side. I want to ask RJ, though, about the overall valuation of the market. As of midday yesterday, 17.8 times forward 12-month earnings, and that's a premium to what we've seen in recent history. Does the market really look like a buy here?
Well, my equity colleagues have been a bit cautious about the U.S. stock market for significant portions of recent weeks. Obviously, we're quite a bit off the lows, as I mentioned before. I think the equity guys here at Federated would agree that the market doesn't look cheap. We on the fixed income side are focusing primarily on valuations on the rates and the credit spread sectors. On rates, we think rates should back up a little bit from where they are. We've seen some of that in recent weeks, but the relatively muted pace of growth that we just discussed should top them off at a pretty moderate level. And then on spreads, we continue to remain positive in the parts of the fixed income market of the more economically sensitive, credit-sensitive assets like high-yield corporates, which we still like.
Yeah, so
the equity market and high-yield corporates are obviously related. Yep. The earnings season very important for both.
But you also have the Fed meeting and the Bank of Japan meeting. How does that play into all of this, RJ? The Federal Reserve kicking off that two-day meeting today. Are you expecting a move in interest rates? And what are you expecting out of the Bank of Japan come Thursday?
Well, here in the United States, we don't expect the Fed to change official interest rates at today's meeting. It starts today. Of course, we'll get the results tomorrow. The improvements from the crazy start of the year have been just too tentative. The economic momentum, as we mentioned, has clearly slowed, even if we're expanding at very marginal rates. I think it's highly unlikely that the Fed would move official interest rates at this meeting. All eyes will be on the tone of the Fed's statement. That first paragraph in the FOMC statement describes how they see the economy. How will they assess the first quarter slowdown that we're obviously going to see in the data in a couple days? How are they going to assess the improvement in financial conditions, which is obviously stimulative? I think on net, they're on hold. Over recent years, they've been sharply declining the expected level of the Fed funds rate through the dot plot, and we have a pretty cautious Fed with a pretty cautious Fed chair at the helm.
All right. We will leave it there. No expectation then for the Bank of Japan meeting, which I know a lot of people are focused on as an even bigger impact. RJ, good to see you, sir. Thanks so much.
Thank you very much.
RJ Gallo.